Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. And today let's talk about some stock market opportunities that are out there. I got to be honest with you, I'm going through the market right now, placing a few orders, but I'd like to hear your ideas. As you know, I talk about the same ideas a lot. I'd like to hear some new ideas that are out there, and I want to address questions as they come in. And we have one right away, and it has to do with the stock that I've talked a little bit over the last couple of months, really since I think about March or so. And I want to go ahead and address that question. And it's hello. I want to know if you will double dip on Moneyline. I bought 10,000 shares at $1.10, but I know it's at 60 cents a share and it doesn't seem to stop going down. So coincidentally, that is about my average entry price as well, is about $1.10. And I have about 15,000 shares overall. And I did buy an additional block of shares as it dipped into the 70s and 60s here, but I'm not going to be buying any more. I'm going to stick around 15,000 or so. So the reasons I bought this stock may be different than the reasons that you bought yours. So I see this as a completely acceptable throwaway risk at this time, meaning that I think Moneyline is a good company. I think they've got a solid business plan. And I'm not going to pretend like I understand every part of their business plan. I don't think that anybody understands every part of every company's business plans, but I'm familiar with the financial industry. I'm familiar with what they're doing. Nothing in the financial industry is a winner take all sort of proposition here. It is whether or not you can build a loyal customer base. They look like they're on the way to doing that. However, all of that may not be enough to save them in a couple of different dimensions. We are in a challenging environment right now where there are some headwinds. We're starting to see some positive things in the financials market that have to do with rising interest rates. But Moneyline in particular, because their market cap is so small, if they continue to stay under $1 per share and they're traded on the New York Stock Exchange, they're going to be forced to delist unless they do a reverse split. So a reverse split is probably what is in the cards for this company. And at this point, it would have to be at least 10-1 or 1 for 10 rather. And they have 6 months to remedy that. So this shouldn't have come as a surprise to anyone who's been in the stock market for long enough that if you own a stock, it dips below $1 a share and it stays there for 30 days. They receive a notice of delisting from the New York Stock Exchange saying, hey, man, you've got 6 months to remedy this. Because of how low the price of the stock is and how small the market cap is, they would probably do a 1 for 10 split, get that up about $6 a share. In that case, you could almost guarantee that, almost, no one can guarantee anything, that the stock would continue to decline another 20% or so. So I've committed the money that I've committed to this. I'm not committing anymore. I've got about 15,000 shares, and it's about $1.10 per share is my cost. So I do this maybe once every 2 or 3 years. I'll take a chance on something that's extremely low price and I'll buy a bunch of it. This is what I did with Neo, and that worked out fairly well. But I can't even recount to you the number of times that hasn't worked out so well. But when it does work out really well, it tends to make up and more for all the times that it didn't really work out too well. So, that my Neo returns were a little bit more than 10x. They could have been more if I'd sold out in the high 60s where I was kind of looking to sell out, but that's not what happened. Moneyline, on the other hand, I think that's a solid company that will continue to grow at rates it's growing right now, which is at 30 and 40% annually. Eventually, it slows down to 10, 15% growth overall. I don't see it ever having the sort of potential, explosive value that we put on things like Square and even on Upstart at one point. But I see it as a solid earner going forward, and they're going to build a pretty solid business. So that is my my take on Moneyline. Is that Moneyline is a growth company at this point still. Their profits, their expenses have risen a little bit this year. They made an acquisition back in February, March of last year that I'm still not 100% convinced was the best idea, but they didn't overpay for it. So we're going to see how that works out for them. And their underlying business is actually fairly solid and growing. How do they compare to SoFi? Which you can't really compare them to SoFi, right? They kind of have different business models and different ways of going about acquiring customers, and they're really targeting different markets. But If I were to compare them, I would say that SoFi probably has a better chance. SoFi is still on track to be profitable by 2024, sometime in 2024, unless they go out and acquire another company, which, to be honest with you, with the rising cost of capital, they will probably not make any more acquisitions in the near future, and they're going to focus on improving financials. With the rising cost of capital for all companies, you're probably going to see mergers and acquisitions decline a little bit. And you're going to see companies focus on the bottom line, which probably means they're going to be cutting back on staff at some point. That's going to be interpreted as a negative sign. I don't necessarily see it that way, particularly in the technology industry. It is a preemptive sign that companies are taking things seriously. They're cutting costs, they're shoring up their bottom line, and they're preparing for a possibly a rough ride in the future. But a lot of these companies needed to trim the fat anyway in terms of employees. And this is always what happens when you have a rapid expansion. You end up adding a lot of people that you don't necessarily need and creating a lot of jobs that you didn't necessarily need to create. And the current market conditions are giving a lot of companies the opportunity to cut their largest expense, which is labor. And people forget that the cost of benefits and additional taxes on top of that labor, you can add another 25 to 30%, depending on, and even more than that, depending on stock compensation plans, particularly companies that have large stock compensation plans. I would not be surprised at all to see massive layoffs and those companies not go through an earnings recession, meaning that their earnings never really decline in real dollars. Their profitability never really takes a hit in terms of real dollars, but they end up trimming their staff anyway, and particularly those that are eligible for stock compensation plans. And that moving forward with new rounds of hiring, the stock compensation plans are probably going to look a lot different. There's a lot of companies out there, SoFi and Palantir come to mind, where stock compensation plans are in line with everything else in the industry. But based on the current financials of the company, they're taking up an inordinate amount of actual money from the company's bottom line. And I would think that most companies are actually going to take the opportunity to reduce some of those stock-based compensation plans. Not good for workers, but better for the company's bottom lines. They're not going to be able to cut it too far, though, because of competition in the industry. Almost every company in the technology industry offers really generous stock compensation plans, but I would not be surprised if we see collusion to a degree, which is illegal, of course, collusion to a degree among these employers to make these plans a little bit more palatable to shareholders. So shareholders have not paid that much attention to these exorbitant plans in the last couple of years, but that seems to be changing. So markets today, I haven't done sort of a general market update in a while. The Dow Jones is up 173 points today. The Russell 2000 up 1.3. The S&P breaking a 5-day losing streak, up almost 30 points, and the NASDAQ 100 up 139. And that's the first positive day we've had in 3 years, markets overall. And for the S&P, it's been 5 days of straight losing. Energy prices. So we're basically, all of the gains in oil this year, the price of oil have actually been wiped out. But by this time, oil is back down to $72 a barrel. But what we are actually at 71.61 today. And Brent crude is at 76.19. And so all of the gains for 2022 have been completely wiped out, yet we're still seeing oil company profits fairly high. That remains to be seen after next quarter. We also saw something interesting today, that the government of Saudi Arabia reported their first surplus in a decade, and that has everything to do with oil prices. But oil prices today are just as low as they were this time last year. And we have seen gasoline prices decline, but they haven't really declined in line with where oil prices should be. So the price point between gasoline prices and oil prices has not matched the sort of levels we saw in 2008 and say that August-September timeframe, 2008, where oil reached almost $147 a barrel. Gas prices were not as high as they are even today. And at this point, we're actually producing more gasoline than we've ever produced. We are drilling and pumping more oil than we've ever produced in this country, and gasoline prices are still exceptionally high. Part of that has to do with how much companies are spending on raising their dividends and how much they're spending on stock buyback programs instead of spending that on expansion of drilling capacity. Part of the reason they're doing that was because of how badly they got burned after 2008. So energy stocks, after hitting a high point, that would have been roughly November 15th of this year, they've declined fairly significantly since that time period. But it is the only asset class other than utilities that is above water so far this year. So this is turned out to be a fairly tepid year in stocks. And we're looking at next year, a number of firms. So I don't know if you guys pay attention to how many times different analysts from different large companies are making these predictions on what the economy is going to look like next year. But I just pulled a collection of Morgan Stanley and a collection of Merrill Lynch reports going back like to June or so. And it's been all over the map, from end of the world to no recession to mild recession, back to end of the world, back to mild recession. So I am of the opinion that we're probably going to see a mild recession in 2023, but the stock market in 2023 may actually look fairly good. Because remember, the stock market is a forward pricing mechanism. It's usually not pricing in what the economy or what the public thinks about the economy today. It's pricing in what the public thinks about the economy 6 months, 9 months, a year from now. So expect the stock market to turn around solidly long before the actual economy does. And let's remember that according to the last GDP numbers, we are not in a recession at this point if we grew at 2.6%. So fire away with any of the questions you guys have today. My voice has been giving me trouble now for the last week or so. So I'm not sure how long I have on this live stream before my voice starts to give out. And but I did want to talk about one thing that is more important than you think. This is a Biden unveils a $36 billion plan for one of America's largest and most troubled pension funds. And why would they be doing this? So Congress is actually sending $36 billion. The White House is sending $36 billion to buttress the Central States Pension Fund, one of the biggest and most troubled funds that manages pensions of over 350,000 union workers and retirees. The pending announcement comes about 21 months after President Biden promised $86 billion to troubled multi-employer pension funds via the controversial provision tucked into the American Rescue Plan. So why would the Biden administration be doing this? So any administration would be doing this. And the reason they would be doing this is because of the Pension Guarantee Corporation. And so there is actually a quasi, just like with the NBIAA and with Fannie Mae and Freddie Mac, pensions have a sort of implicit guarantee by the federal government, meaning they are insured up to a certain amount. I don't recall what the actual amount is, but I think it's actually $52,000. When I first got in the business, it was guaranteed up to $32,000. So if you had a pension that was worth $100,000 a year when you retired and the pension collapsed, then the Pension Benefit Guarantee Association or corporation, whatever it's called now, they would guarantee you up to $33,000 a year. I think over the years now, that's reached about $52,000 a year. So what I can guarantee you is that the number that they put into, and this is a company that is going to be explicitly backed by the federal government now, since the federal government explicitly backed Fannie Mae and Freddie Mac during the 2008 crisis, they would not let the Pension Guarantee Association go under, right? So in this case, I can guarantee you that the $36 billion to buttress the Central States Pension Fund is less than what the Pension Guarantee Association would be on the hook for if that pension fund collapsed entirely. So it's probably a cost-saving measure in terms of for taxpayers. So yeah, let me see here. Majid says, how's it going? It's going really well. It's going better. I've been sick for the last week or so, off and on. So I've been kind of lazy and not getting a lot of exercise. So I'm feeling kind of fat. Let me see. 180 to 195 million barrels per day release must have had some effect. I don't believe that it's 180 to 195 million barrels per day, considering that Russia by itself only releases about 4 million barrels per day of oil. So, it hasn't. The release, I think, has been targeted at right around 1 million barrels per day, which is about a quarter of the production of Russia. The Strategic Petroleum Reserve, which I don't know why, I've got this comment a few times that, the Strategic Petroleum Reserve is something that's reserved for warfare or something like that. That's not true at all. You can go to the website where they talk about this and really price stability on there. But the releases are really more symbolic than anything else. And they're generally more symbolic than anything else, and it's not really going to do much to affect the price of oil. It basically is there to reassure traders that the futures traders that the government is doing something. The cap on, and there's a something mysterious going on right now in the port of Houston. There's a tanker sitting out there with a 200,000 barrels of oil in a tanker that has no provenance, that we don't know where it's from, and they're offering it at like rock bottom prices at something like $30 less than a barrel of oil actually costs. I would assume that this is either Iranian, Venezuelan, or Russian oil, most likely Russian oil, that made it onto the market somehow and is now being offered at a giant discount. And if they're offering it a $30 discount, it means they probably bought it for less, or they just have to get rid of it at some point. So that is exactly what we want to happen with these sanctions. Here's what else is happening with the sanctions on Russia, and when it comes to capping the price of oil at, I think, $60 a barrel is where they capped it. It pretty much guarantees that that Russia can only sell oil at a loss. But how deep is that loss going to cut? Well, it really depends on the volume of oil that they're pumping. So here's the problem with the volume of oil that they're pumping, especially now as that we're approaching wintertime. Russia cannot stop pumping oil because of environmental conditions that are there. They require massive technological and materials assistance to build the pipelines and infrastructure they need. And they require massive amounts of foreign expertise to actually maintain that infrastructure. And so I haven't really verified this, but I was listening to a well-respected executive in the oil industry talking about the last time we had one of these large Trans-Siberian pipelines burst. And he was stating that it took almost 30 years to restore that production because of the environmental challenges of building this pipeline in the middle of nowhere where there are almost no people, where there's a lot of obstacles getting things in there. There's a lot of weather obstacles in maintaining it. So essentially, they cannot stop pumping, and they may actually have to increase the volume of oil they're selling at that lower price just so it doesn't affect their finances quite so much. So this was the agreement by the European Union to do this, and what was an absolute devastating blow to the Russian economy, which makes me a little bit more hopeful that we may see the end of the Ukraine war sooner than I was thinking. I've been thinking since about June that this is going to last years and years and years, and possibly there's going to be 3 or 4 rounds of warfare. So let me see here. Did you hear that TD Ameritrade will move to Schwab? So TD Ameritrade and Schwab merged, I believe, 2 years ago. So their systems have remained separate for the last couple of years. So like I have a TD Ameritrade account and I work with Schwab, and I know that they don't talk to each other. So one of the firms I've worked with in the past is cleared with Schwab, and I wasn't able to just have my my compliance person look at my TD accounts through their access because the systems didn't talk to each other. At some point, I think that they're going to merge systems. So I'm looking forward to that. But no, the merger was done a long time ago. There's no like arbitrage opportunity there or anything, or opportunity to buy things. So this is big news here, guys. FTC seeks to block Microsoft deal with Activision Blizzard. After kind of looking at the particulars of this case, and honestly, guys, I'm not a lawyer, so don't take my word for this. It looks like they're going to be fairly successful in blocking that deal. They made a pretty good case, at least a couple articles that I read, that it's going to harmfully limit healthy competition in the high-performance gaming console market and subscription service market. So, and it really has to do more with consoles and anything else. So, like, I have no idea why. I always sneeze on my live streams and sneeze almost at no other time. But anyway, so let me see here. Yeah, they sent email before 2 days to every client. That's going to be great. I'm actually not a huge fan of Schwab's system, so I really hope they don't change the functionality of TD systems, because Schwab's customer-facing systems are not my favorite compared to what we have on TD. Like the only thing we can't do on TD is fractional share trading, but I don't do any fractional share trading anyway, so that's not a big deal for me. But in terms of like options trading and things like that, I really like TD setup, and I really like it through Thinkorswim as well, which is their mobile platform. And I don't advertise their mobile platform or anything like that. I'm not sponsored by anything, but that's one of the mobile platforms that I use. The other accounts, like I have a WEBULL account. I don't have a Robinhood account, but I've got a WEBULL account. I've got a SoFi account. To be honest with you guys, I don't really use those. It's, I bought a few things in there and I keep the accounts open because occasionally someone goes into the description of one of my videos and they'll click on the link and I'll get a little commission from that, anywhere from like $8 to $25 in stock every time you guys do that. So yeah, but yeah, so that is it. They take from my 30% tax. Huh. I'm not sure what you mean by that. Yeah, not sure what you mean by that. So other headline here, and this shouldn't be news, and I don't know why it is not why it is news. But the headline here is this: sell GameStop stock. The turnaround is fruitless, and the NFT business is failing. So I never got involved with the GameStop mania. I only made one video on it, and it was fun to watch. But I'll be honest with you, this company never had a hope in hell of a turnaround. Their business model is just not set up for it. And because of the increased cost of capital, because of the low capitalization of their company, they cannot raise enough money in order to make the transition to something new. So they are going the way of the dinosaurs. They're going to be out of business in a couple of months, if not a year. And I think that is about it. They're going to liquidate. They're going to be liquidating physical assets by the end of the year. That is my take. And I don't know why people get so uptight about this company, like trying to have a conversation about how useless this company is in the modern environment and how they won't be able to pivot. It's like running up against like criticizing someone's religion almost, where there is no amount of logic that will get through to them. So yeah. So other economic news is coming up here on the 13th and 14th, and that is going to be the Federal Reserve's December meeting, where we are going to find out whether or not they slow the pace of interest rate increases. I am betting that the interest rate increase for December is going to be 0.5 point. I would be severely disappointed if the interest rate increase for December was 0.75 point, and I think markets would be severely disappointed as well. I think, though, that look at the betting markets on this. The markets favor a 50 basis point rise or 0.5% rise for December, slowing down sometime in first quarter of next year, sometime after first quarter of next year to 0.25 point per quarter, and possibly ending by the end of first half, where they'll probably hold rates steady for a while, maybe start to decrease rates. But it looks like the Federal Reserve is intent on normalizing the fixed income market kind of back to where it was pre 2008, normalizing interest rates to what they were somewhere pre 2008. And I think it's about time to do that. And I think they're looking to normalize their balance sheet as well. So, which means that interest rates are probably going to stay elevated, not just until middle of next year. I don't think if you have a mortgage on your home at 2.75% or 3 or even 3.5%, I don't think we're ever going to see those, at least in my lifetime. I don't think we will see those rates again. We are going back to an historical normalized interest rate environment. So, yeah. So fire away with questions, guys. I'm not getting a lot today. I generally like to have a little bit more interaction with my audience, but I don't have much of an audience today, probably because I haven't been quite as consistent lately in terms of getting on the air. But that has been because I've been sick, guys. Sorry about that. Also, in terms of me making videos, this is just my busiest time of the year in terms of my actual work. So I haven't had as much time to sit down and concentrate on making videos other than doing a few earnings reviews and that sort of thing. So didn't want to talk about the news surrounding Tesla today. There's been a report that Tesla may be freezing hiring at Giga Shanghai. and maybe actually slowing production by cutting shifts by about 2 hours. So I will say one thing. It may be that the company is just fully staffed there at this point. And it may be that cutting shifts back by 2 hours or so is simply a way of accommodating everyone with enough hours and providing a little bit of relief for a workforce that's been overworked for years and years. It may not be a demand problem like people think there is, largely because with China opening back up, and it looks like that the public protests, they were shut down by the Chinese government, from what I understand. We haven't heard a lot from that in the last couple of days. They were absolutely shut down, and the methods used were something straight out of like science fiction, where people were getting phone calls saying, "Hey, you walked by this protest yesterday. Why don't you talk to me a little bit about what you were doing?" And this was the government calling regular citizens saying, "We have your cell phone data. We know you were near a protest. Please tell us what you were doing." And this sort of put a lot of fear into people, and they stopped protesting. But I think that the government has listened to the sentiment of the people. They're going to open up. What this means in terms of the impact of COVID on their population, we have yet to see. Like I don't know how successful their strategy was in terms of zero COVID. It may be that populations now don't have any natural immunity to COVID. And it may be also that even though they don't have natural immunity to COVID, the dominant strains that are out there right now are a lot less impactful health-wise than they were earlier in the pandemic. So it may not make that much. But here is what is happening is that the Chinese consumer is ready to spend. They are ready to spend money, and that could be very, very good for Tesla's bottom line. We don't know what's happening over there yet, and I think we're not going to know for the next couple of months. But they're dealing with a property crisis, and so there's a lot going on there. I wouldn't say that anybody really knows everything that's going on with Tesla right now, or not with Tesla, but with China right now. So let me see here. All right, a lot of negative news on Tesla right now, and this is the time generally that I like Tesla, is when I see a lot of negative news. If you're a new investor to Tesla, what has happened this year where we've gone from a high of 402 down to a low of 166? This is not the first time something like this has happened where we've seen this kind of loss in this stock. The stock tends to cycle like this, and I've been underwater sometimes for years on this stock, and it's made me a lot of money over the years, and I'm not planning to sell anything. I have started to sell, started to buy puts around this stock. I'm not selling any call options around the stock right now because I fully expect a share buyback to be announced sometime at the end of this year. And in that case, the stock will probably rise. I think the stock will probably rise next week on Federal Reserve news. And but by the end of the year, I fully expect clarity on Cybertruck, more clarity on Cybertruck, and an announcement that there is going to be some sort of stock buyback. Yeah. So, what is your thoughts on the much talked about and hyped recession and impending recession? So, yeah, let's talk about that for a minute. So, recessions, guys, are totally normal. There is a credit cycle that determines when we go into recessions, meaning that when enough bad loans get sent out into the ether and they start to go bad, that tends to be when we go into a recession and we see restrictive credit. And a lot of that is going to be driven by loans that were made on a variable basis. I mean, take, for example, what's going on right now with Twitter, where personally Elon Musk borrowed $14 billion to fund the Twitter deal from a bunch of banks. And he may be forced to actually put up some of his Tesla stock as collateral and take out a margin loan on that in order to pay off some of that $14 billion in debt, largely because that $14 billion in debt had a floating interest rate associated with it. And interest rates have risen quite considerably. And the interest alone on that is, I think, more than Twitter has ever made in profits, meaning it's about a little bit more than $1 billion in interest per year. I don't think Twitter has made $1 billion in profits in their entire history. So that in this case, like I said, this is a loan that could go bad. And they're basically forcing him to take some of that off the table by putting his Tesla stock on margin. If he puts his Tesla stock on margin, remember the stock would still have to drop a lot before he got a margin call where he was either forced to sell that stock or to put more of his own money into that account, right? So it's basically like stretching out, reducing the near term interest cost to the banks that money, shifting it over to Elon himself, and reducing some of the risk to the banks, shifting it to Elon himself and the performance of the stock. So, which look, even if it's on margin, he's going to be writing options on that stock anyway to generate income to offset some of the interest cost. And a really decent options trader can make about 0.5% per month without taking on a given account, without taking an undue amount of risk, which would go a long way towards cutting the interest expenses. So for his overall bottom line, this is not a bad strategy at all. I don't think he really wants to put that stock at risk, but he may end up being convinced to do that by some of his banking advisors. And I think going forward, that's probably what we're going to see. That will have a negative impact on the stock, even though I don't really think it should have a negative impact on the stock. I actually think that next year, while the general stock market will probably not do too well, I think that Tesla far outpaces the gains in the general stock market. And a lot of that has to do with increased capacity, expanding to new markets, and partially has to do with the Tesla Semi, but it's going to have more to do with the Cybertruck coming up here in the future. There's just going to be a whole new market there. I think they just passed 1.5 million in pre-orders for the Cybertruck, so that's actually pretty exciting. But so a lot of stocks had big days today. Amazon had a big day. Nvidia had a big day, and Snowflake had a big day. In fact, let's talk about Snowflake. This is one of the companies that I made a video on a few months ago when they were at like $150 a share. They dropped down to 125-ish or so. I think 125-ish or so, which is where I made a purchase on it, and I've been sitting on it ever since. But I've been watching the action in this stock for quite some time now, and this is probably going to make it into my options portfolio. You want to have a degree of volatility when you're trading options because it makes the options more expensive, and therefore the premiums you generate by selling options worth a lot more, right? But in the case of something like Nvidia, where it's so volatile that you cannot rely really on delta as a measure of risk, meaning that if you're looking at the Greeks in stock option trading, which you should be taking a look at the Greeks, that give you a way to quantify the risk associated with each position that you have. I don't think there's a way, and I've run the numbers several times using this spreadsheet that I designed, where you can't really rely on delta to determine the risk of exercise associated with an option on Nvidia once you get out beyond like 30 days. It's useless. It's completely useless. Snowflake, on the other hand, may be the one stock that I add to replace Nvidia in an options portfolio. I've completely taken Nvidia out. I'm just sitting on 100 shares now and not thinking about trading it. It's every option strategy I've ever tried on that has blown up in my face, and I've ended up having to unwind a trade at a large loss. So not going to make that mistake again. Snowflake, on the other hand, has just enough volatility to make it work fairly well. And if you guys don't know what I'm talking about, so you can trade options on indexes as well because of the lower volatility than in comparison to individual stocks to a degree. What you have is lower priced options going forward, meaning I think I sold 370 options on VOO, which is the S&P 500. And I think I sold them for like 370 a piece or something when I bought it at like 363. And so what I ended up doing is I had some cash. I didn't want to tie it up permanently, but I wanted to generate some income. So I went ahead and I bought 100 or 200 shares of VOO, and I sold two options on it at 370, which are going to expire next week on the 16th. So I've generated about about $700 in premium on that. If it goes up to, and I think it's what is VOO today, like 365 or something. So I'm above water in terms of the actual value of the stock that I purchased. I'm underwater in terms of how much the option would be worth if I wanted to buy back. But it looks like by the end of December 16th, I'm either going to sell sell VOO at a profit, or I'm going to get exercise and sell it at a profit of something like $1,200, right? My position. And that's not bad for a short turnaround. This is not something that I concentrate my portfolio on. It's definitely not something I do. The core of my portfolio is an ETF portfolio where I don't really think about it that much. I just put money in it and I let it ride. But to some degree, this year has been a little bit more fun to play options because selling calls for the most part while the market is going down, they just expire out of the money and you get to collect the premium. The danger is when the market turns around, those stocks might start getting called away. And when you try to repurchase, you don't have enough money to buy the same amount of shares that you owned, just before it exercised. So, uh, okay, guys, any thoughts that you guys might have, go ahead and please share those. But my thoughts on hyped recession and impending recession. So recession has been, so you can go back and Google recession and put a year in, recession and put a year in and just Google it. And you will find every year there are dozens of predictions by experts of recession. And most of the time it doesn't happen. We only on average have a recession once every 6 years, once every 5 or 6 years or so. It's been less frequent since 2000 or so, but once every 5 or 6 years. But yet every year someone is reporting recession. In fact, I did a live stream on this a few months ago where I brought up articles from like 2014, 15, 16, 17, 18, 19, 20, where everyone was talking about a recession in these articles and no recession ever happened. So the ability to predict a recession is actually very bad, especially in 2008. There was a brief period in 2008 where the economy looked like it was on really shaky ground and the federal government had to step in to sort of backstop and rescue the fixed income market. And the danger was very real of a collapse at that point. And it's something that has been completely ignored by markets now, market historians. They don't even understand that happened. It just isn't news anymore. So do I think there's a higher likelihood of a recession in 2023? I do. My opinion is that recession is probably going to be shallow. But it's going to be, the initial effects may be magnified by panic from new investors. Although I think a lot of new investors have gotten shaken out of the market already. I think a lot of people that started by in 2020 contributed in a way to the bubble that we went through. I think a lot of those folks are out of the market. And I think that we're looking at something that hasn't really happened in history very much with the Federal Reserve, where they have managed to unwind a number of asset bubbles without having a crash. So they're unwinding the housing bubble right now. They've unwound the bubble in technology stocks. I think that the bubble in technology stocks is not that when technology stocks are 50% higher, it's not that they weren't worth it if you're looking at a 5-year projection of earnings and revenue. But in terms of current cash flow, they weren't worth the prices that we were looking at, 6 months ago, 7 months ago. I don't buy generally for that time range. When I buy a stock, it's like I said, my usual intention is to hold it forever. So I have a pretty long time horizon on things. But when you take a look at where stocks were when they were about 50% higher versus where they are now, I think that this is one of the only cases that I can remember in my career where the Fed was able to unwind a bubble without things totally collapsing into panic. And I think that's pretty amazing. But okay, guys, I am not getting a ton of interaction today, and my voice is already starting to bother me only 40 minutes into this. So I'm going to go ahead and take off today. But I did want to thank you guys for tuning in. I'll be back on Tuesday for sure, even though I have guests in town. Let me see. Michael says, you'll be able to tell when things approve. Crypto will go to the moon, says the crypto skeptic. Maybe. Crypto, like I said, the strongest correlation that it shows is actually a correlation to young male unemployment. So when we have a high degree of young male unemployment, I think that would be a good time to buy more crypto, but I don't view this as an investment. I view it as a speculative vehicle at this point. And I do still own some crypto. Like I own a little bit of Bitcoin, a little bit more of Ethereum, and I own a little bit of Algorand. But other than that, I don't have any other cryptocurrencies. And I probably won't purchase any more cryptocurrencies. I'm more interested in the underlying blockchain technology. But when young male unemployment begins to peak at say 4.5% to 5% or so, that is probably when I'll go ahead and go out and buy some more crypto. There'll probably be a spike in that time period. Crypto's gone through a couple of winters before, We're definitely in a third crypto winter at this point, and at some point it'll probably recover because I think that the underlying technology may have needed what is going on right now. But thank you so much, guys, for tuning in, and thank you so much for your kind words. I will see you guys next Tuesday.